If you're an Indian working in the US, someone is trying to give you free money every single month, and here's a very good chance you're not taking all of it. That's the 401k, and most NRIs either don't fully understand it or understand it too late. Here's what too late looks like. You spend years in the US contributing diligently, watching your savings grow. Then you decide to move back to India. You withdraw your money, and quietly, without anyone warning you, you end up paying tax on it twice. Once in the US and once again in India on the same money you worked years to save. It actually doesn't have to go that way. There's a specific window, completely legal, available to almost every returning NRI, where you can actually bring the money back to India and pay zero Indian tax on it. Most people miss it, not because it's hidden, but because nobody explained it to you before you needed it. That's what this video is for. By the end of this video, you'll know exactly how a 401k works, how to never leave your employer's free money unclaimed, and precisely how to use that window so that when you do move back, you're not handing the government money you didn't have to. Let's get into it. Now, I've seen these mistakes, including the double taxation, play out more times than I can actually count. Nearly 2 decades at EY, PwC, and one of India's top wealth management firms will do that for you. I'm Nikhil, and this is FinNiki, where I simplify money the same way I practice it. Alright, let's start at the very beginning. What is 401k? A 401k is a retirement savings plan offered by your employer. You can't open one on your own. It has to be provided by the company you work for. And the money you contribute is directed directly from your paycheck automatically before even it hits your bank account. Now here's where it gets interesting. There are 2 types of 401k plans. Type 1, traditional 401k, which is pre-tax. You contribute here. The money goes into before taxes are deducted, so you reduce your taxable income today, the money grows over the years, and you only pay tax when you withdraw it in retirement. Think of it this way, you're deferring the tax bill to your future self, who will hopefully be in a lower tax bracket. Type 2, Roth 401k, which is post-tax. Here, you contribute money that's already been taxed. No tax break today, but the big win, when you withdraw in retirement, you pay zero tax. Not a rupee, not a dollar, nothing. So traditionally, you pay tax later. In Roth, you pay taxes now, enjoy freedom later. So which one is better? It all depends on whether you expect to be in a higher or a lower tax bracket when you retire. We'll come back to this when we talk about planning for India. So how much can you contribute? Let's talk numbers. For 2026, if you're under 50 years old, you can contribute up to 24,500 per year from your own paycheck. That's just your contribution. Your employers is on top of this. If you're 50 and above, the government gives you a catch-up contribution. You can put an extra 8,000, taking your total to 32,500 per year. And if you're married and your spouse also works, they can contribute 24,500 separately. As a household, you could be putting away 49,000 a year just in 401k contributions. There's also IRA, individual retirement account, not tied to your employer. Annual limit is about 7,500. Comes in traditional, which is tax break now and pay later, or Roth, pay now and tax free later. Both flavors are available. You can use both a 401k and an IRA together. They complement each other beautifully. Many employers match 100% of your contributions up to 5% of your salary. Say you earn $120,000 a year, 5% equals $6,000. You put in $6,000, your employer matches the same $6,000. Employers' contribution don't always come fully yours on day one. Most companies have a vesting schedule. Example, say in a 3 years vesting, year 1, 2,000 of employers 6,000 is yours, year 2 another 2,000, and year 3 all 6,000 is fully vested. The golden rule, always contribute at least enough to get the full employer's match. If your employer matches up to 5% and you're only contributing 3%, you're leaving money on the table every single month. Don't do that. Here's where it gets really interesting. The employer matches free money unless it's part of your CTC. The tax advantage, that's where 401k goes from good to extraordinary. If you're finding this useful so far, hit the like button and subscribe and stay with me because this next part is worth your full attention. 2 terms to understand: marginal tax rate, rate on your highest dollar, and effective tax rate, what you actually pay on average. A married couple earning $120,000 a year in 2026 falls into the 22% bracket, but the effective rate is maybe 13 to 14% because only the top slice is taxed at 22%. So when you contribute to the 401k, you reduce the top slice first. That's where the savings hit hardest. Advantage 1, tax deferral savings. Earn $120,000 a year, contribute $20,000 to a traditional 401k, you're taxed only on $100,000. Federal tax savings approximately $4,400. State tax savings for a California, which is 10%, is about $2,000. So total annual savings $6,600. Advantage 2, tax deferred compounding. Let's look at the same scenario. $120,000 income, $20,000 per year at 8% return for 20 years. Without 401k contribution, that results into $13,400 invested every year, which is about $675,000. With 401k, $20,000 per year is invested, which results into over $1 million. Difference, $330 entirely from tax deferred compounding. So what's the challenge? 1. Money is locked up. Withdraw before 59.5 years, pay a 10% penalty plus income taxes. 2. Market risk. Invested in stocks, bonds, mutual funds, no guaranteed payout. 3. Requires active decisions. You choose your investments. No attention can leave you in low return funds. Should you invest if you plan to move back to India? My honest answer, yes, in most cases you still should. Reason 1, the employer matches non-negotiable. An instant 100% return on your contribution unless it's part of your CTC, and even after penalty and taxes on eventual withdrawal, you still come out ahead. Not contributing is like turning down a part of your salary. Nobody does that. Reason 2, plan changes. Most people plan to stay for a couple of years. Those 2 years becomes 5 years, then 10 years. Contribute, take the tax benefit, let the money grow, decide what to do with it later. What happens to your 401k when you move back to India? You have 5 options, but first 3 things to understand because they directly determine which option makes the most sense for you. 1. The early withdrawal penalty. Withdraw before age 59.5, 10% penalty plus income taxes, expensive without planning. 2. Tax filing status in the US. Once you are a non-resident for US tax purposes, fewer deductions, larger taxable portion on withdrawals. This is why timing matters so much. 3. The RNOR phase. After living abroad for a significant period, you may qualify for RNOR status, resident but not ordinary resident status. During the RNOR phase, your global income is generally exempt from India income tax. This is your window to act. Estate Act warning is also there for non-residents. Non-resident exemptions are just $60,000 compared to 13 plus million for US citizens. Anything above that is taxed at up to 40%. This is why letting your 401k sit in US indefinitely without a plan carries more risk than most people realize. So what are your 5 options? Option 1, leave the funds in your employer's plan. The first option is the easiest one. You do nothing, your money stays exactly where it is, but easy isn't always smart. Employer-sponsored plans typically give you a limited set of funds to invest in. And the expense ratios, meaning the fees you pay, tend to be higher than what you would find elsewhere. Less choice, higher cost, not a great combination for the long term. Think of this as a holding position, something you do temporarily while you figure out your next move, which for most people should be option 2. Option 2, roll over to a traditional IRA, and this is the one I would actually recommend for most people who want to keep their money invested in the US. You take your 401k and roll it into a traditional IRA. No penalty, no tax, nothing triggers. Your money just moves and keeps compounding exactly as before. The difference, with an IRA through a custodian like FinNiki or Vanguard, you suddenly have a much wider range of investment options and significantly lower fees. More flexibility, lower cost, it's a straightforward upgrade. Now, a practical note, and this one matters. FinNiki and Vanguard both accept foreign addresses, which means you can manage the account from India after you move. But open the account while you are still in the US. It's considerably easier with a US address, and you can only roll over once you have left your employer. So the sequence is this: leave the job, then roll over. This option makes sense only if you want your money staying in US dollars, if there's a chance you might want to come back to US someday, or if you want to leave behind something for your kids who may study or settle there. Just one thing to keep in mind, similar to the earlier option, as a non-resident, your estate tax exemption on US asset drops to just $60,000. So if you're planning to hold a large IRA for a long time, factor that into the picture and work with a CPA who understands cross-border planning. Option 3, roll over to Roth IRA. The third option is rolling to 401k into a Roth IRA instead of traditional one. Like the traditional rollover, there's no 10% early withdrawal penalty here, but there's a difference. Since the Roth is a post-tax money, whatever you roll over gets added to your taxable income in that year. So you will have a tax bill in the year you make the move. But honestly, for most NRIs, that's not even the biggest problem. The bigger problem is India. There are no clear rules on how Roth IRA earnings are taxed here. In the US, completely tax-free, but India may not recognize that, which means when you withdraw, those earnings could be taxed in India. So if you take a conservative view and assume they are taxable in India, which is actually the view, then the whole point of Roth, the tax-free withdrawal, starts to fall apart for someone living permanently or long-term in India. And same estate tax concern applies here as with the traditional IRA. So unless you have a specific reason for the Roth, it's generally not the strongest option if India is your permanent home. Option 4. Withdraw during the RNOR phase. This is the one I've been waiting to get to since the very first line of this video. Let me walk you through real numbers with real examples so you can see exactly what it looks like in practice. Say you have $100,000 in your 401k, you qualify for 2 years of RNOR status. So you withdraw 50,000 in year 1 and 50,000 in year 2. On each 50,000 withdrawal, you pay 10% penalty, that's 5,000 straight away. Then there's US income tax on top of that. As a non-resident filer, that works out to roughly around $5,000 to $6,000. So your total cost on each withdrawal is somewhere around 20 to 22%. Yes, that's a real cost. I'm not going to pretend it isn't. But here's what you get in return. Zero Indian taxes because you are in the RNOR phase. No ongoing reporting complexities, no estate tax exposure on those funds once they are back in India, a clean exit. And you don't have to take it all at once. You can even spread withdrawals across your RNOR years, stay in lower US tax bracket and bring that overall cost down. The more RNOR years you qualify for, the more room you have to optimize. For a lot of returning NRIs, this is the cleanest path available. You pay a known cost, you close the chapter and move on. Option 5, withdraw after RNOR as a full Indian resident. Now, what if you've already crossed out of the RNOR window, or what if you never qualified for it? This is where things get more complicated. Once you are a full resident, ordinary resident in India, any withdrawal from your 401k is going to attract tax in both countries. You pay US tax on the withdrawal and India wants its share too. There is some relief built into the system under Section 89A of the Income Tax Act. If you file Form 10EE, India taxes you at the time of actual withdrawal, not on gains you haven't realized yet. That's a meaningful protection, and the double taxation avoidance agreement between India and the US gives you foreign tax credit, so you're not paying the full tax amount twice on the same money. Navigating Section 89A, Form 10EE and DTAA credit simultaneously can be complex. This is not something you want to figure out on your own, so work with a CA who understand both Indian and US tax laws. The decision you make here have real consequences, so don't navigate them alone. See, a 401k is one of the best financial tools available to you in the US. The tax savings, the employer match, and the power of compounding make it genuinely powerful, especially in the early years of your career. Like we discussed earlier, if your employer offers a match, always contribute at least enough to get it. Always, no exceptions. For those planning to move back to India, it's more complicated but entirely manageable. If you plan ahead, use the RNOR window wisely. Consider the traditional IRA rollover for USD denominated goals and work with a CA who understand both tax systems. The 401k isn't just a retirement account. For NRIs who plan it right, it's a tax optimized wealth transfer between two countries. That's worth understanding. If this video gave you clarity, give it a like and share it with someone in the NRI community who needs to hear this, and drop your questions in the comments. I read every single one. That's it from me. I'm Nikhil. Subscribe to learn how to make your finances less tricky with FinNiki. Thanks for watching, and I'll see you in the next one.